The years between the last paycheck and age 73 are, on paper, the cheapest tax years of a saver's life. The salary has stopped. The required minimum distributions have not yet started. Social Security may still be deferred, growing at 8% a year until 70. For a stretch of time, sometimes 5 years, sometimes 12, a household can sit in a tax valley it will never see again. And the standard advice about that valley is almost unanimous. Fill it. Take money out of the traditional IRA, pay tax on it now at a low rate and move it into a Roth where it will never be taxed again. Convert every year, right up to the top of the 12% bracket, or the 22% bracket, whatever the household can afford. Do it while the rates are cheap, because they will not stay cheap. The logic is clean, and it deserves to be taken seriously. Consider a married couple, both 63, who have just retired with $1.4 million in traditional pre-tax accounts. This year their taxable income is modest, maybe $40,000 from a small pension and some dividends. The top of the 12% bracket for a married couple in 2024 sits at roughly $94,000 of taxable income. That leaves something like $50,000 of headroom that could be converted and taxed at just 12%. Now run the clock forward. At 73, RMDs begin. The IRS forces withdrawals from that pre-tax balance, whether the couple needs the money or not. A $1.4 million account, growing at a reasonable rate, can easily become $2 million by then. The first mandatory withdrawal alone can exceed $70,000. Stacked on top of Social Security, that income does not land in the 12% bracket anymore. It lands in the 22 and it pushes the next dollars toward 24. So the arithmetic looks obvious. 12% now or 22% later. Pay the lower rate voluntarily today, or pay the higher rate by force tomorrow. Every year spent in the valley without converting is a year of cheap tax space left on the table, space that expires and never comes back. This is why the strategy spread. It is not folklore, it is not a sales pitch. It is a genuinely rational response to a real feature of the tax code. And for a specific kind of saver, it has produced real savings, sometimes 6 figures over a retirement. Financial planners repeat it because, under the assumptions it was built on, it works. That last phrase is the one to hold on to, under the assumptions it was built on. Because here is the uncomfortable observation. Across the same population of disciplined savers, the ones who did the reading, who understood the valley, who dutifully filled the bracket every single year from retirement to 73, a meaningful share end up worse off than if they had done less or nothing at all. Not through carelessness, through following the advice precisely. That is the puzzle this video exists to solve. If the gap years really are the golden window, why does the very discipline everyone recommends quietly cost so many households money? The answer starts somewhere unexpected. The rule that millions repeat, fill the bracket, capture the arbitrage, has an origin and a set of buried assumptions that almost no one who follows it has ever actually read. The phrase, fill up the bracket, did not descend from the tax code. No statute contains it. It is a rule of thumb, and like most rules of thumb, it was forged in a particular decade, for a particular set of conditions, and then outlived them. Trace it back and the story begins in 1997, when the Taxpayer Relief Act created the Roth IRA. For the first time, an American could pay tax on retirement money today in exchange for a promise that it would never be taxed again. But the conversion mechanism, as most planners now use it, moving large traditional balances into a Roth in a deliberate multi-year campaign, did not become mainstream advice until later. The turning point came in 2010. That year, Congress removed the income cap that had barred higher earners from converting at all. Suddenly, conversions were open to everyone, and the planning profession went looking for a framework to govern them. The framework it settled on was elegant and easy to teach. Look at your marginal bracket this year, find the top of it, and convert exactly enough to reach that ceiling without spilling into the next one. Fill the 12, fill the 22, repeat annually. A client could understand it in one sentence, and an advisor could defend it with a single number. But notice the world that rule assumed. It assumed brackets were relatively stable year to year. It assumed the cost of a conversion was captured almost entirely by the income tax rate itself. That 12% meant 12%, full stop. And it assumed that the household filling the bracket today would still be a household filing jointly at similar income in the years when the conversion was supposed to pay off. Each of those assumptions was reasonable in 2010. Each has quietly frayed since. The profession has been surprised by tax law before. In 1986, the Reagan tax reform collapsed 15 brackets into essentially 2 and eliminated deductions that entire financial plans had been built around. Strategies that were optimal on a Friday were obsolete by Monday. Then in 2017, the Tax Cuts and Jobs Act cut individual rates sharply and wrote its own expiration date into law. Most of those individual provisions are scheduled to sunset after 2025, which would push the 12% bracket back toward 15 and the 22 toward 25. The rule of thumb treats today's rates as a fixed reference point. History treats them as a moving one. So the heuristic is not wrong so much as it is frozen. It captured a real insight. That voluntary tax at a low rate can beat forced tax at a high one, and then hardened that insight into a mechanical instruction that stopped asking the one question that actually decides the outcome. Here is the consequence. When a saver fills the 22% bracket, the 22 is doing enormous work in that sentence. It is standing in for the entire true cost of the conversion. And the true cost is almost never just 22%. It is the income tax, plus whatever the conversion does to the price of Medicare 2 years later, plus what it does to how a surviving spouse will be taxed alone, plus the growth surrendered on every dollar spent paying the bill. The rule counts one of those costs and ignores the rest. Which means the rule quietly hands the whole decision to a single hidden assumption, an assumption about what the household's tax rate will be and who the household will be at the moment the conversion is supposed to pay off. That assumption is not about this year, which anyone can measure. It is about a future no one can see. What exactly is the danger that filling the bracket is supposed to neutralize? Strip away the jargon, and it has a name planners use almost affectionately: the tax torpedo. And to respect the strategy honestly, the torpedo has to be seen for what it is: a real, mechanical spike in a household's tax rate that arrives on a fixed schedule and cannot be argued with. Return to that couple with $1.4 million in pre-tax accounts. Watch what the machinery actually does to them at 73. The required minimum distribution is not a suggestion. It is a formula. The IRS takes the account balance on December 31st and divides it by a life expectancy factor from a published table. At 73, that factor is roughly 26.5. A $2 million balance divided by that factor produces a mandatory withdrawal of about $75,000. Money the couple may not want, may not need, and cannot decline. It is taxable income by force. Now stack the layers, because that is where the torpedo detonates. On top of the RMD sits Social Security. And Social Security has a cruel mechanism of its own. As other income rises, a larger fraction of the benefit itself becomes taxable, up to 85%. So the RMD does not just add its own $75,000 to the tax return. It drags previously untaxed Social Security dollars into the taxable column alongside it. 1 forced withdrawal, 2 rising numbers. The result is a marginal rate that briefly behaves like something much larger than the bracket it sits in. A single extra dollar of RMD can pull 85 cents of Social Security into taxation with it, so that dollar is taxed as if it were $1.85. Households in the 22% bracket can face effective marginal rates on that stretch of income of 40% or more. That distortion, a modest statutory bracket producing a punishing real rate, is the torpedo. It is not a metaphor. It is the interaction of 2 formulas that were never designed to be read together. And here is the part that makes the gap year strategy genuinely rational. Every dollar converted to a Roth before 73 is a dollar that permanently leaves the pre-tax account. It shrinks the balance that the RMD formula will later divide. A smaller pre-tax balance means a smaller forced withdrawal, which means fewer Social Security dollars dragged into tax, which means the torpedo is diffused before it can ever fire. The couple pays a known, moderate rate today to disarm an unknown, sharper rate tomorrow. Convert enough, early enough, and the mandatory withdrawals at 73 stay small enough to land in a lower bracket, with benefit taxation held down alongside them. Seen this way, the strategy is not aggressive for its own sake. It is preventive. It trades a controlled cost now for the removal of an uncontrolled cost later. That is coherent, defensible engineering, and for the household whose numbers actually match this scenario, it can save a great deal of money over a 30-year retirement. The torpedo is real. The mechanism that diffuses it is real. The logic connecting them is sound, which is exactly why the failure is so hard to see coming. If the torpedo is genuine, and filling the bracket genuinely dismantles it, then the strategy should be safe by construction, difficult to overdo. Disarming a threat is supposed to be a one-directional good. And yet, the households who disarmed it most diligently are precisely the ones this video keeps returning to, the ones who did everything right and finished behind. So the question sharpens into something almost paradoxical. If the torpedo is real, why would filling the bracket ever be the wrong defense against it? Everything the strategy claims to save rests on a single subtraction. Not a table, not a bracket chart, not the size of the pre-tax balance. One number. The difference between the marginal rate a household pays to convert a dollar today and the marginal rate that same dollar would face if left alone and withdrawn later. That is the whole decision. Convert at 12, face 22 later. The differential is positive 10 points and the conversion wins. Convert at 22, face 12 later. The differential is negative 10 points and the conversion loses, quietly. Every year it is repeated. The rule of thumb almost never states this out loud, because stating it forces a question the household cannot answer by looking at this year's tax return. Here is what the number hides. Fill the bracket measures only the left side of the subtraction, today's rate, which is knowable, printable, comfortable. It assumes the right side, the future rate, is higher. That assumption is the entire strategy. Remove it and nothing is left. The heuristic does not calculate the differential, it presumes its sign. So run two households through the same machine and watch the sign flip. Household A, married, 1.4 million pre-tax, no pension, delaying Social Security, retiring at 63 into a genuine income valley. Their conversions this year cost 12%. Their RMDs at 73, stacked on Social Security, would have landed dollars at an effective 40% once the benefit torpedo is counted. For them, the differential is enormous and positive. Filling the bracket is not merely defensible. It is one of the highest return moves available to them. This is the household the strategy was designed for, and it works exactly as advertised. Household B, married, the same 1.4 million but with a $4,000 a month pension that never stops and never shrinks. That pension already occupies most of the 12% bracket before a single conversion happens. To fill the bracket, this couple must convert at 22% today. And their future? The pension, the RMD, and Social Security together keep them in the 22% bracket for life, the same rate, forever. Their differential is roughly zero, and once the cost of paying the tax bill from the portfolio is counted, it is negative. Same balance, same age, same advice. Opposite outcome. The only variable that changed was the one number the rule never asks about. And notice what happens to household B when the differential is zero. They pay 22 cents of real, spendable money today to avoid paying 22 cents later. They have not saved a rate. They have merely accelerated a payment, handing the Treasury its money years early and surrendering all the growth those tax dollars would have earned in the meantime. The conversion did not diffuse a torpedo. There was no torpedo at their future rate. It simply moved a fixed cost forward in time, which is the definition of a loss. This is the assumption buried inside fill the bracket, that tomorrow's marginal rate on this dollar will be higher than today's. When that holds, the rule is close to optimal. When it fails, because a pension fills the low brackets, because a spouse's income persists, because tax law resets rates upward for everyone equally, because the household was already at its ceiling, the rule keeps issuing the same instruction while the arithmetic underneath it has reversed. The mechanical version cannot tell the difference. It converts identically in both households because it never looks at the right side of the subtraction. It sees cheap tax space and fills it, the way water fills whatever shape it is poured into, indifferent to whether filling helps. The answer to what quietly decides the outcome is now visible. It is not the balance. It is not the age. It is not the discipline. It is the direction of a single inequality, future rate versus present rate, and the rule of thumb resolves that inequality by assumption rather than by measurement. which leads to the sentence a diligent saver most needs to hear before the next conversion, and least wants to. When today's rate beats tomorrow's, the conversion is not a smaller win. It is a slow loss, repeated on schedule, dressed as prudence. Look at a Medicare premium statement for a retired couple 2 years after a large Roth conversion, and something odd appears. The income tax on that conversion was paid and closed long ago, but the premium is higher than it was, noticeably higher, and it will stay higher for a full 12 months. Nobody converted anything this year. The bill arrived anyway. That delayed, almost invisible echo has a name. It is called IRMAA, the Income-Related Monthly Adjustment Amount, and it is the first place the money quietly leaks out of a strategy built to save it. Here is the mechanism. Because it is not intuitive, Medicare Part B and Part D premiums are not flat. Above certain income thresholds, they step up, and they step up in cliffs, not slopes. Cross a threshold by a single dollar, and the entire monthly premium jumps to the next tier for both spouses for the whole year. And Medicare does not look at this year's income to set the surcharge. It looks back 2 years. The conversion a couple runs at 65 determines the premium they pay at 67. Put numbers on it. In 2024, a married couple filing jointly stays at the base Part B premium as long as their modified adjusted gross income sits at or below $206,000. $1 over, and the surcharge begins. The tiers climb from there, roughly an extra $70 per person per month at the first cliff, then more at each one above it, with Part D surcharges stacked on top. At the higher tiers, the combined surcharge for a couple can exceed $500 a month. $6,000 in a single year, triggered by income the couple chose to create voluntarily through a conversion. Now watch how the gap year strategy walks straight into it. A Roth conversion is, by design, added income. That is the whole point. It pulls money out of the pre-tax account and onto this year's return. But IRMAA counts conversion income exactly as it counts a paycheck. So the household that fills the bracket aggressively, converting $50,000 or $80,000 in a year, can push its modified adjusted gross income across a Medicare cliff it never saw on the tax form. The income tax software showed 22%. It said nothing about the surcharge landing 2 years later. And this is where the differential from a moment ago quietly gets worse. Recall the household whose future rate roughly matched its present rate, the one already close to breaking even on the conversion itself. Add an IRMAA cliff to their conversion year, and the arithmetic tips further into the red. They did not just accelerate a tax payment, they bolted a Medicare surcharge onto it. The rule of thumb counted the 22, it never counted the 6,000. There is a cruel timing detail worth holding. Because IRMAA looks back 2 years, the surcharge often lands after the conversion window has closed, after the couple has stopped converting and assumed the cost was behind them. The bill for a 64-year-old's aggressive conversion can arrive the same year Medicare begins at 65, greeting the household precisely when it is most sensitive to fixed costs. The strategy paid its visible price years earlier. IRMAA collects the rest on a delay. None of this makes conversions wrong. For the household with a genuinely large differential, absorbing a 1-year surcharge to diffuse a lifetime of torpedoed RMDs can still be worth it. IRMAA does not reverse the logic. It sharpens the size of the bet, and it punishes the household that was already close to the line. But notice something about IRMAA as a cost. It shows up on a statement. It has a threshold, a tier, a dollar figure. A careful planner can see it coming and root around it. It is a surcharge you can measure. The costs that follow cannot be read off any statement at all. IRMAA is only the leak you can see. The most expensive event in a couple's retirement is often not a market crash or a medical bill. It is the death of one spouse, not for the reasons anyone grieves. For a reason buried in the tax tables, one that most conversion plans never model, because it feels indecent to model it. Consider a couple, both 74, who did everything the gap year playbook asked. They retired at 63, saw the valley, and filled the 22% bracket every year until RMDs began. They converted a great deal. Their remaining pre-tax balance is modest now, their income is steady, and filing jointly they sit comfortably. Roughly $200,000 of taxable income, a joint standard deduction, brackets that stretch generously across 2 lives. On paper, they are exactly the disciplined household the strategy was built to reward. Then one of them dies. The survivor grieves for a year, and then files a tax return, and the return has changed in a way no one warned her about. The income is nearly the same. The pension continues. The Social Security survivor benefit replaces most of what was lost. The RMDs keep coming from the account she inherited. But she is now a single filer, and the single filer brackets are not half the married brackets. They are far narrower. Here is the mechanism, stated plainly. In 2024, the top of the 12% bracket for a married couple sits near $94,000 of taxable income. For a single filer, it collapses to about $47,000. The 22% ceiling for a couple is around $201,000. For a single filer, it falls to roughly $100,000. The standard deduction is cut nearly in half. Same income, half the room to hold it. So the survivor, with income barely reduced from when there were 2 of them, is now pushed up through brackets that shrank underneath her. Income that was taxed at 12% as a couple is taxed at 22% as a widow. Income that was 22% becomes 24%. Her IRMAA thresholds have as well, so the Medicare surcharge she escaped as a couple now lands on her alone. This is the widow's penalty, a step up in tax rate triggered not by earning more, but by becoming one person instead of 2. Feel what that does to the household that grieved. She did not get richer. She lost her spouse and, in the same stroke, lost the wider brackets that spouse's mere existence provided. The tax code quietly reprices her entire remaining income at a higher rate for the rest of her life on a return she files alone at the kitchen table. Now the turn, because this is where the belief breaks in the opposite direction from everywhere else in this video. For most of the failure cases so far, the lesson has been convert less. The pension household, the zero differential household, the IRMAA cliff. All of them argued for restraint. The widow's penalty argues the other way. Because if there is a high probability that one spouse will spend years, even a decade, as a single filer with joint-sized income, then the future marginal rate on that pre-tax balance is not the couple's rate. It is the survivor's rate, the compressed, single filer rate. And that changes the differential. A couple looking only at their joint brackets might see their present rate matching their future rate and conclude the conversion is a wash. But if they run the future at the survivor's brackets, the future rate is higher, sometimes dramatically. Suddenly, the conversion at today's joint 22% is diffusing income that would have been taxed at the widow's 24%, on top of the widow's IRMAA. The differential the mechanical rule missed was hiding inside a table nobody wanted to open. So the correct answer for this household is more conversion, done deliberately while both brackets are still wide. The exact opposite instruction from the household 2 blocks ago. Same strategy, same code, and it has just reversed direction again on a variable no year's tax return will ever show you. A conversion has a second bill that no one prints, and it is settled the moment the tax comes due. Not the rate, the source. The single question of where the tax payment comes from can turn a winning conversion into a losing one, and it is the question the rule of thumb never even poses. Here is the claim, stated flatly. A Roth conversion is only as good as the money used to pay its tax. Pay the tax from outside the retirement accounts, from cash, from a taxable brokerage kept for exactly this purpose, and the conversion works the way the math promises. Pay it from inside, by converting $1 and skimming the tax off the top of that same dollar, and the strategy silently eats itself. Watch 2 households run the identical conversion and diverge. Household C converts $80,000 this year and owes, say, $17,000 in tax. They have a taxable brokerage account, and they pay the $17,000 from it. The full $80,000 lands in the Roth. Every one of those dollars now compounds tax-free for the rest of their lives. They have moved money from a taxed forever account into a taxed never account and paid the toll with outside cash. Clean. Household D converts the same $80,000, owes the same $17,000, but has no outside cash, so the tax comes out of the conversion itself. Only $63,000 actually reaches the Roth. The other $17,000 left the tax-sheltered system entirely. It went to the Treasury, and it will never compound for them again, in any account, ever. 63 versus 80. That gap is the leak, and it does not close, it widens. Follow it forward 20 years at a modest 6%. Household C's $80,000 becomes roughly $256,000, all of it tax-free. Household D's $63,000 becomes about $202,000. The difference, more than $50,000 of foregone tax-free growth, is the compounding that the $17,000 in tax would have earned had it stayed invested. Household D did not just pay the tax, they surrendered every dollar that tax would have generated for 2 decades. That is the opportunity cost, and it is invisible on the year 1 return, which showed both households an identical conversion and an identical bill. Now deepen it, because the damage runs one layer further. If the household is under 59.5, skimming the tax from the converted amount can itself be treated as an early distribution, triggering a 10% penalty on the money used to pay the tax. A conversion meant to save money can, in that case, manufacture a penalty out of thin air. Even past that age, the structural loss remains. Paying tax from the portfolio shrinks the very asset base the strategy exists to grow. And here is where this leak fuses with every leak before it. The households most likely to lack outside cash are often the ones with everything locked in pre-tax accounts. The disciplined savers who put every spare dollar into the 401k for 30 years. They are precisely the households the gap year strategy targets most aggressively. The advice tells them to convert heavily. Their own balance sheet forces them to pay the tax from inside. The strategy hands them the instruction and the trap in the same breath. So the true cost of a conversion is never the printed rate alone. It is the rate plus the Medicare surcharge 2 years out, plus the widow's bracket reset, plus the growth surrendered on every dollar spent paying the bill. 4 costs. The rule of thumb counts 1, which forces the accounting to its real conclusion. Every leak traced so far, the zero differential, the IRMAA cliff, the compressed survivor brackets, the tax paid from the wrong pocket, points back to the same unasked question, not how much to convert, who this strategy was ever actually built to serve. Lay the 4 leaks side by side, and a pattern appears that no single one of them reveals alone. The zero differential. The Medicare cliff. The compressed survivor brackets. The tax paid from the wrong pocket. Each was traced separately, and separately each felt like an exception, a special case that a careful household might route around. Placed together, they stopped looking like exceptions, because they all drain from the same reservoir. Here is the mechanism that unites them. A Roth conversion is a decision to pay a cost now in exchange for removing a larger cost later. That is the entire engine. And an engine like that only produces value when one condition holds. The cost removed must genuinely exceed the cost paid. Every leak in this video is the same failure wearing a different mask. A situation where the cost paid was real and immediate, while the cost removed was smaller than it appeared, or was never there at all. Watch the 4 collapse into 1. The zero differential household paid a real 22% to avoid a future 22%. Cost paid, real. Cost removed, illusory. The IRMAA cliff added a measured $6,000 to the cost paid while removing nothing on the other side. The survivor brackets are the one case where the mechanism runs forward. There, the future cost is genuinely larger, so the conversion earns its price. And the tax paid from inside the account did not misjudge the differential at all. It shrank the asset that every future dollar of benefit was supposed to compound within. Same engine, 4 different points of failure. 1 where the trade is honest. 3 where the household paid to remove a cost that was smaller than the payment. The money leaks wherever the conversion is priced by its rate alone, because the rate is only one of at least 4 costs, and it is the only one the tax software prints. The 3 unpriced costs, the Medicare echo 2 years out, the survivor's reset, the growth surrendered on the tax dollars, do not appear on any conversion worksheet. They are settled later on other statements, in other years, by a household that has usually stopped thinking about the decision entirely. That is the relief hidden in all of this. The failures are not random. They are not bad luck. They are not the market. They are a single accounting error, repeated, counting one cost and calling it the whole price. Which means they are visible in advance to anyone willing to price all four before converting rather than after. And now the revelation, the thing every leak has been circling. The rule of thumb was never wrong for everyone. It was built for one specific balance sheet, and it works flawlessly on that balance sheet. The household with a deep income valley, no pension, a large pre-tax balance, outside cash to pay the tax, and a future rate genuinely higher than today's. For that household, filling the bracket removes a torpedo, dodges the cliffs, and pays the toll from the right pocket. Every mechanism lines up in its favor. The strategy did not break. It was simply applied to households whose numbers do not match the one it was engineered for. The advice generalized. The arithmetic did not. Which is why the question can no longer be how much to convert. That question assumes the answer is positive and only asks the size. The prior question, the one the whole accounting now demands, is whether this particular household sits inside the narrow profile the strategy was built to serve, or outside it, where filling the bracket quietly leaks money it was meant to protect. So who does still belong in the conversion column? The objection writes itself, and it deserves a hearing. If this video has spent 8 blocks exposing leaks, isn't the honest conclusion simply to stop converting? Hasn't the case against filling the bracket become a case against conversion itself? No. Pretending otherwise would repeat the exact error the video was built to correct, trading one blanket instruction for its opposite. There is a household for whom aggressive conversion is not a trap, but the single highest return move on the table, and that household deserves its steelman stated as fully as the rule of thumb ever got. Picture the profile precisely because precision is the whole point. A married couple retires at 62 with $2 million in pre-tax accounts and almost nothing else generating income. No pension. Both delaying Social Security to 70. Their earned income has stopped. Their forced income has not begun. For 8 years, they sit in a genuine valley, taxable income low enough that conversions this year cost 12, maybe 15%. They hold $400,000 in a taxable brokerage account, money they can use to pay the conversion tax from outside the shelter. And they have run the survivor math honestly. Whichever of them outlives, the other will file single, with joint-sized RMDs from a $2 million balance, landing dollars at the widow's 24% with the widow's IRMAA stacked on top. Now price all four costs, the way the rule of thumb never does. The differential is large and positive, 12 now against a future rate that, whether measured jointly or at the survivor's compressed brackets, runs far higher. The Medicare cliff is a one-year cost this couple can see and absorb, trivial against a lifetime of diffused torpedo. The survivor's reset argues for more conversion, not less. Every dollar moved now is a dollar the widow never faces at her narrowed rate. And the tax is paid from the brokerage so the full converted amount lands in the Roth and compounds untouched. Every mechanism that sank the other households lines up in this one's favor. For them, filling the bracket is not merely defensible. It is close to optimal, and the 6 figures the strategy promises are real. The rebuttal to the objection is not convert less, it is sharper than that. The strategy was never wrong. It was misapplied. The households it destroyed value for and the households it enriched were handed the identical instruction, and the instructions served the second group flawlessly. Notice what actually separates the winner from the losers, not the balance. Household B had the same $2 million, not the discipline. Every failure case followed the advice precisely. Not the age, not the account size, not the effort. The couple in this block wins for one reason. Their future marginal rate genuinely exceeds their present one, and they can pay the tax from the right pocket. The pension household lost because their future rate matched their present rate. The zero differential household lost for the same reason, wearing a different mask. One variable decides all of it, and the rule of thumb, in every version repeated for 15 years, never once asks about it. It measures this year's bracket, finds the ceiling, and fills. It looks exclusively at the left side of a subtraction, whose sign is set entirely by the right. The entire decision, for the winner and the loser alike, collapses into a single comparison, not a bracket chart, not a fill-the-space instinct. One number weighed against one other number, measured rather than assumed. The winners and the losers of this strategy differ by exactly that comparison, the one the heuristic never puts on the page. And once it is on the page, every rule of thumb this video has dismantled can be replaced by it. Every heuristic dismantled in this video, fill the 12, fill the 22, capture the valley, diffuse the torpedo, can be retired and replaced with a single comparison. Not a chart, not a ceiling, one rate weighed against one other rate. State it cleanly. Convert a dollar only when the marginal rate you would pay to convert it today is lower than the marginal rate that same dollar would face if left untouched and withdrawn later. Present rate on the left, future rate on the right. Convert when the right side is higher, stop when it is not. Everything else in this video was commentary on how to measure those two numbers honestly. The power of the rule is that it absorbs every leak already traced. The future rate is not this year's joint bracket carried forward on autopilot. It is the true forward rate, the RMD stacked on Social Security, the benefit torpedo counted in, the survivors compress single filer brackets weighted by the odds one spouse outlives the other, the IRMAA cliff. The conversion income might trip 2 years out. And the present rate is not the printed statutory percent alone. It carries the growth surrendered on every tax dollar paid from inside the account. Price both sides fully and the 4 leaks stop being separate warnings. They become inputs to one subtraction. This is not a slogan, it is a measured finding. Boston College's Center for Retirement Research, modeling optimal Roth conversion strategies across thousands of simulated households, reached a conclusion that reads almost as a rebuke to the rule of thumb. The value of conversion is driven overwhelmingly by the spread between current and future marginal tax rates. And for a substantial share of households, the tax rate path is flat or declining, meaning conversion adds little or destroys value. The gain, where it exists, concentrates in the households whose forward rate genuinely rises. Not most, a defined subset. Watch the rule sort the households from earlier blocks in a single pass. The couple in the deep valley with no pension and a large balance, present rate 12, future rate, measured at the survivors' brackets with the torpedo counted well past 24. Right side higher, convert, and convert heavily. The pension household, present rate 22, future rate 22 for life. The two sides match. Convert nothing. There is no spread to capture, only a payment to accelerate. The household with everything locked inside the 401k and no outside cash. Even where the raw rate spread looks positive, the growth surrendered on tax paid from within pulls the effective present rate up until the spread narrows or closes. Same rule, 3 verdicts, each falling out of the comparison automatically. Now apply it, because the rule is only useful as a habit. Before any conversion, a household builds 2 numbers. First, the marginal rate on the next dollar converted this year, visible, printable, honest. Second, the marginal rate that dollar would meet in the RMD years, run at the survivor's filing status, with Social Security taxation and IRMAA folded in. That second number takes work. It requires projecting a balance forward, pulling the life expectancy factor, testing what happens when 2 filers become 1. It cannot be read off April's return. That difficulty is precisely why the heuristic exists. The rule of thumb is what people reach for when the real comparison is too much effort to run. But the effort is the strategy, the number is the whole game. A household that has built both sides of that subtraction has already made every decision this video circled for 9 blocks. How much, whether, when, in what order. The comparison does not merely inform the plan, it is the plan, reduced to its irreducible core. And here the relief finally lands. The failures were never mysterious. They were households converting with the left side measured and the right side assumed. Measure both, and the paralysis lifts. The question stops being how aggressive should I be, and becomes which side of the subtraction is larger, and by how much. That is answerable. That is calm. That is a decision a person can actually make. Knowing the rule, though, is not the same as executing it. A positive spread tells a household to convert. It does not tell them how much to convert in which year, or in what order the moves must fall to keep every one of those dollars inside the low rate that made the spread worth capturing in the first place. A positive spread is a green light with no speedometer. It tells a household to convert. It says nothing about how much to move this year, or next, or in what order. And that omission is where a correctly diagnosed strategy still gets driven off the road. Here is the trap in the timing. The spread that made conversion worthwhile existed because the present rate was low, but conversion income raises the present rate. Convert too much in a single year, and the last dollars converted climb into a higher bracket, quietly erasing the very gap that justified the move. The rule, convert when the future rate is higher, has a silent partner. Convert only up to the point where this year's marginal rate is still below that future rate. Cross it, and the final dollars are being converted at a spread of 0 or worse, the pension household's mistake, reproduced inside a single tax return. So the window is not filled, it is metered. Run 2 households through the same 8-year valley to see the difference. Both are the winning profile from earlier. $2 million pre-tax, no pension, delaying Social Security, outside cash for the tax. Their forward rate, measured at the survivor's brackets with the torpedo counted, sits near 24%. Household E converts aggressively. Year 1, they push conversions to the top of the 22% bracket, reasoning that 22 still beats 24. On paper, the spread is positive. But they trip an IRMAA cliff 2 years out, and their final converted dollars earned a spread of barely 2 points against a Medicare surcharge that ate most of it. They filled the space fought back. Household F meters. They convert only to the top of the 12% bracket in the early years, when Social Security has not started and the valley is deepest. Each of those dollars carries a spread of 12 points, not 2. They stay clear of every IRMAA threshold. They spread the same total conversion across all 8 years instead of front-loading it so no single year spikes into a punishing rate. By 70, their pre-tax balance has been drawn down deliberately, evenly, at the widest spread available in each year, and not $1 was converted at a rate that beat the future by less than the effort was worth. Same profile, same total moved. One household captured a 12-point spread 8 times, the other captured a 2-point spread once and called it discipline. That is sequencing. It is the recognition that the low-rate space in the valley is not one pool to be emptied, but 8 separate annual allowances, each with its own ceiling set by that year's other income. The art is filling each year up to the point where the next converted dollar would cost more than it saves, and no further. Delay Social Security and the early years hold the most room. Watch the IRMAA thresholds as hard walls, not soft suggestions. Leave a small buffer below each cliff, because a dividend or a capital gain can push a return over a line the conversion alone would have cleared. There is an order to it too. Convert first in the years before Social Security begins, when the valley floor is lowest. Convert less or pause. In any year, a large one-time income event is already crowding the brackets. Keep the outside cash reserved strictly for the tax so that every converted dollar reaches the Roth hole. Sit with what this really means. The spread told the household whether the window was worth using. Sequencing decides whether they actually get to use it, or whether they compress 8 years of cheap tax space into 2 expensive ones and lose most of the gain to their own impatience. The strategy that fails and the strategy that works can share the same diagnosis and the same total conversion and diverge entirely on the calendar. Which leaves one thing unmeasured. Every number in this playbook, the spread, the sequence, the survivor's rate, the metered ceilings, assumes the household controls the one variable it cannot see. One last question decides whether the whole window was ever theirs to use. One variable is run underneath every household in this video, and no household controls it. The tax law itself, the spread, the sequence, the survivor's rate, the metered ceilings, all of them are measured against a future set of brackets that Congress can rewrite at any time. That is the last unseen number, and it cuts both ways. Set the 2 directions side by side. If rates rise, and the 2017 individual provisions are already scheduled to sunset after 2025, pushing the 12 toward 15 and the 22 toward 25, then every future rate on the right side of the subtraction climbs, and conversions done today at a locked-in low rate look better in hindsight. If rates fall, or a household's own income drops further than projected, the future rate sinks, and conversions done aggressively today look like a payment made early for nothing. The 1986 reform erased strategies overnight. The 2017 cuts wrote their own expiration into law. The honest planner does not pretend to know which way the next reform breaks. The honest planner builds a plan that survives being wrong. If the gap years are the golden window, why do so many disciplined savers who filled the bracket every year end up worse off? Because the window was never golden by itself. It was golden only for the household whose future marginal rate genuinely exceeded its present one, and the instruction they were handed never checked whether that condition held. They filled the bracket because the rule said fill the bracket. They measured the left side of the subtraction and assumed the right. For the pension household, the right side matched the left, and every disciplined year quietly accelerated a payment that saved nothing. For the household paying tax from inside the account, discipline shrank the very asset the plan existed to grow. For the couple facing a survivor's compressed brackets, the same discipline, aimed correctly, would have saved a fortune, and often didn't, because no one opened that table. The failure was never carelessness, it was a rule that answered a question it never asked. So the correction is not convert less, it is not convert more. It is to stop treating the valley as a space to be filled, and start treating it as a spread to be measured. Build both numbers. The present rate on the next converted dollar, which anyone can read, and the true future rate. The RMD stacked on Social Security. The benefit torpedo. The survivor's single-filer brackets weighted by the odds. The IRMAA cliff 2 years out. Convert when the second number is genuinely higher. Meter each year to the point where the next dollar would cost more than it saves. Pay the tax from outside the shelter, and leave room for a law that may not cooperate. That reframing dissolves the paralysis the whole strategy created. The disciplined saver was never failing at discipline, they were applying it to the wrong number. Move the discipline from filling the bracket to measuring the spread, and the same diligence that quietly costs some households money becomes the thing that protects it. The gap years remain real, the tax valley is real. For the household whose numbers match the profile, converting through it is among the highest return moves available in a retirement. But golden is not a property of the window. It is a property of the differential, and the differential belongs to the household, not to the calendar. Every number in this playbook points to one act a household can actually perform before its next conversion. Run the subtraction honestly, both sides, in real dollars, against its own survivor math and its own forward brackets. Do that, and the decision stops being a leap of faith dressed as prudence. It becomes arithmetic a person can stand behind. This is education, not personalized advice. Run your own numbers, or have them run. Because the only wealth worth building is wealth built to last.